Bob and Linda each saved the same $500,000. They both needed $30,000 to repair their storm-damaged roof. Bob pulled his money from pre-tax retirement account. He got hit with a large tax bill that can even raise his Medicare premiums. Linda used cash and qualified Roth money. Her federal tax bill? Zero. Same emergency and savings, but completely different outcome. It was never about how much they saved. It was about which account they used when they needed the money. In this video, I'll show you the 8 retirement accounts that create those choices, the new 2026 rules you need to know, and a practical order for funding them. And stay till the end of the video, because I'll show you 2 bonus opportunities that help your family build generational wealth. Let's start with the plan you get at work, your 401k, 403b, or TSP. For 2026, you can contribute up to $24,500 individually. If you're 50 or older, you can contribute more. And from age 60 through 63, your total contribution limit increased to $35,750. But here's the catch. If your W-2 shows you earned more than $150,000 in Social Security wages in 2025, your 2026 catch-up contributions goes into the Roth side of the plan, regardless of your filing status. So how can you take advantage of your 401k account? First, set up your contribution to match your employer's match. If your employer offers 50 cents on the dollar up to 6%, take that full 6%. That's literally free money and an instant guaranteed 50% return. Once you've captured the full employer match, don't send any additional dollar. Overfunding this account triggers required minimum distribution when you turn 73. The IRS forces you to withdraw and pay tax on it, even if you don't need the money that year. This could land in the same year as you pay for a big medical bill, a home sale, or anything significant, pushing your tax bill higher. The simple way around this is to put your money into an account that doesn't force withdrawals. And if your plan doesn't offer a Roth option at all, catch-up contributions for anyone over that $150,000 is blocked entirely. Don't just assume you are fine. Call your HR department this week and verify your options. And if you have extra money, one of the most tax-advantaged accounts in America is probably sitting unused in your benefits portal right now. Most people think you only get an HSA through an employer. That is not true. If you have an HSA-eligible health plan and no disqualifying coverage, you can open one yourself through an HSA provider or a brokerage that offers HSAs. One of the biggest mistakes is treating the HSA like a debit card. Every dollar you spend today is a dollar that can no longer stay invested and potentially growing tax-free for future healthcare expenses. At the federal level, the HSA account has triple tax advantage. Your contribution is tax deductible. Money in the account grows tax-free each year, and you pay no tax when you use it for eligible medical expenses. That third benefit is valuable, and most people don't realize it. Let me show you an example. Frank is 82, and he's moved to memory care. The bill comes out to $9,800 a month. His son Mike is on the phone with billing because the 401k account they used to cover the medical costs triggered a surprise tax bill. Every withdrawal counts as an income, and the bigger the withdrawal, the higher his tax bracket. Frank needs his 401k to carry him through his 80s, but it is getting taxed like a paycheck. At the exact moment his family struggles to afford the medical cost. Now, picture a different scenario. Same $500,000 in the 401k account. Frank is 82, and he doesn't touch this account for medical expenses. Instead, he pays through the HSA account he opened decades ago. Over the years, he simply kept the money in the account invested. Assuming an annual 5% compounding rate, he's managed to grow a substantial nest egg. And the best part? Every dollar that comes out from his account is completely tax-free. Same Frank, in the unfortunate situation, his family must pay tax on every withdrawal. Instead, Frank could have built a substantial nest egg through decades of compounding, and he doesn't need to worry about taxes at all. That's the power of an HSA account. Nearly 70% of people who turn 65 need some kind of long-term care. Assisted living costs more than $70,000 a year. A nursing home can run past $100,000 a year. Medicare doesn't cover almost any of it. The HSA account is built to absorb those expenses. Every dollar spent on qualified long-term care comes out tax-free, no matter how large the bill gets. You can even use it to pay premiums on a qualifying long-term care insurance policy. But here's what you need to be careful with. It is strictly for only medical expenses. If you use the money for a vacation before 65, the IRS will charge you income tax plus an additional 20% penalty. So, here is how you can take full advantage. When cash flow allows, pay the small medical bills out of pocket, leave the money in your HSA invested, and save your receipts. Under current rules, you can reimburse yourself later for eligible expenses going back to whenever the account was opened. A receipt for this year can pay you back at 68 or fund a facility bill at 84. For 2026, you can contribute $4,400 with self-only coverage or $8,750 for family coverage. If you are 55 or older, you can add another $1,000. Starting in 2026, individual market bronze and catastrophic health plans are treated as HSA compatible, giving more people access to this account. If no one ever told you about HSA pays you back decades later, hit that subscribe button, because the next account has another rule that can make your retirement money far more flexible than most people realize. Your medical bills are covered, but how do you fund the rest of your retirement tax-free? That is exactly where the Roth IRA comes in. You fund this account with money you've already paid taxes on. As the original owner, you are never required to withdraw during your lifetime. The money can simply compound through your 70s and 80s, and you can pass on the entire amount to your kids completely untouched. The withdrawal of your original contributions can be done at any time, with no penalty and completely tax-free. For 2026, the contribution limit is $7,500 or $8,600 if you are 50 or older. There are income limits that restrict high earners from contributing directly, which I've put on the screen right here. But here's a strategy that catches a lot of married couples by surprise. If you are not working, but your spouse is, you can still fund a Roth IRA in your own name using their income, so long as you file jointly and you are both over 50. That is $17,200 of tax-free money you can shelter every single year. Roth IRA gives you flexibility and tax-free money later. But let's be real, $7,500 a year is not enough to retire on. Most of your lifetime savings is likely inside an employer's 401k. When you leave that job, you are most likely rolling that money into an IRA. But before you roll over that 401k, you need to know the rule of 55. If you leave that employer during or after you turn 55, you may be able to withdraw from that plan without paying the 10% early withdrawal penalty. You still need to pay ordinary income tax on the withdrawals, and the plan itself must allow it. So make sure to check with your HR. Before you roll anything into an IRA, ask yourself one question. Do you need this money before 59 and a half? Imagine you just retired at 56 and you have $400,000 in your old 401k. If you leave the money in the same account, you won't need to pay the 10% early withdrawal penalty. The trap begins when people accidentally roll that money into a traditional IRA, and the rule of 55 disappears. So, a $40,000 withdrawal suddenly triggers a $4,000 penalty, simply because the money is in the wrong account. Now, what if you want to retire even earlier, maybe at 50? You need money before most retirement accounts are available. A taxable brokerage account can serve as the bridge. There is no retirement account contribution limit, no income limit, and no minimum withdrawal age or penalty. This account gives you total control and flexibility, but it is not tax-free. Dividends and interest may be taxable, and selling an investment for more than you paid creates a capital gain. There can also be an estate planning benefit under current federal rules. Inherited investments use the current value as their new cost basis. This means decades of growth you never cashed in simply disappears, reducing the capital gains tax on appreciation. Sometimes that can be substantial gains. But you are trading flexibility with market risk. If the market falls when you just retired, taking money out for living expenses force you to sell investments at the worst possible time. That is why you need the next account to protect your investments and give them time to recover. This is where a high-yield savings account or short CD ladder comes in. The goal is to have enough for 1 to 2 years of living expenses, just in case a bad year happens in the market. It is not an investment, it is a shock absorber, so you don't sell your stocks at the worst time. We saw that happen in 2022 when the S&P 500 fell nearly 20%. It is then followed by a strong rebound in 2023. A cash reserve can give your investments time to recover, but the opposite extreme can also hurt you. Keeping 5 to 6 years of expenses in cash may feel safe, but inflation can gradually reduce what that money can buy. Up to this point, all these accounts help you form the foundation of an early retirement plan. But public sector workers may have access to one more account, and it makes retirement before 59 and half much easier. That account is a governmental 457B offered by cities, states, local governments, and public school systems. Once you separate from that employer, the plan may let you withdraw money at any age without the usual 10% penalty. The withdrawals are still taxed as ordinary income, and money rolls rolled in from another type of account might not have the same exception. For someone planning to stop working before 59.5, this is the most valuable account. But make sure yours is governmental, because some nonprofit organizations, including certain hospitals, offer non-governmental 457B plans. But those plans work very differently, and the money remains the employer's property. You generally cannot roll it into an IRA or another plan. Same name, very different account. Confirm which version you have. And here is why the 457B becomes especially powerful. A public employee with both a 403B and a 457B may be able to contribute $24,500 to each in 2026. That is $49,000 across the two accounts before catch-up contributions. That is two separate savings limits, and they don't need to wait until 59.5 to access the money. Public employees may get that advantage through their employer. Self-employed people can create a different advantage by building the retirement plan themselves. If you earn money through freelancing, consulting, or a side business, you may be able to open a solo 401k or SEP IRA. The solo 401k can be especially powerful because you contribute in two roles, once as the employee and again as the employer. But if you already contribute to a 401k through your regular job, don't count the employee limit twice. Your business may still make an employer contribution, but you don't receive a second employee bucket through your business. Here's an example that shows how the accounts work. A consultant nets $80,000 this year, and he opens a SEP IRA. The contribution only happens as the employer. That is about 20% of his net self-employment earnings, roughly $14,800. But if he opens a solo 401k, he can contribute $24,500 as the employee, plus the same $14,800 as the employer. That brings his total contribution to over $39,000. Same person, same $80,000 income, same tax year, but the amount going toward his retirement just more than doubled, simply because the other account gives more option. But there is one more difference if your business starts hiring. A solo 401k is generally designed for an owner with no employees other than a spouse. With a SEP IRA, the percentage you contribute for yourself must also be contributed for every eligible employee. That can turn a simple retirement plan into a much larger business expense. That covers the 8 core retirement accounts. But before we decide where your next dollar should go, there are 2 family-focused opportunities worth knowing. The first is the 529 to Roth IRA rollover. If your child has money left in a 529 after college, up to $35,000 may be moved directly into their Roth IRA without tax or penalty. The 529 must have been open for at least 15 years. Each transfer is limited by that year's Roth IRA limit. The money your child never needed for college could become a $35,000 head start for their retirement. The second is the Trump account, officially launched in July 2026. Families and employers can contribute up to $5,000 a year while the child is under 18. U.S. citizen children born between 2025 through 2028 may also receive a one-time $1,000 government contribution. And here's what Trump account can do for your child. According to a U.S. government estimate, an account opened at birth and funded with the maximum limit each year can grow to roughly $304,000 by age 18 and more than $1 million by age 28. The numbers are not guaranteed, but they show what decades of compounding can do before the child even begins a full-time career. These are bonus opportunities, but your own retirement still comes first. So, after looking at all 8 accounts, where should your next dollar go? If you're a regular employee, start with your 401k, contribute enough to receive the full employer match. Next, fund your HSA if you're eligible, then fund your Roth IRA. After that, go back to your 401k and increase your contribution. Once those accounts are working, build your cash reserve. Any additional long-term money can then go into a taxable brokerage account. If you're between 60 and 63, your 401k gets an extra boost. Instead of the regular $8,000 catch-up, your plan may let you contribute an additional $11,250, bringing your total possible contribution to $35,750. Once you turn 64, that special catch-up contribution disappears. So if your budget allows, these are 4 valuable years to use. If you work in public service, you should still begin with the employer match and the HSA. But after that, your governmental 457B deserves serious attention. Money originally contributed to the 457B can generally be accessed without the usual 10% penalty, even if you are not yet 59.5. And if you're self-employed, there is no single order that works for everyone. Start with the HSA. If you're eligible, then look at your solo 401k. Make the employee contribution of $24,500 first. After that, decide where the next dollar helps you more. Roth IRA for tax-free money later, or the employer side of the solo 401k for a larger tax deduction today. If your cash flow allows, you may be able to fund both. Remember Bob and Linda with the broken roofs? Linda didn't have more money. She simply had more choices: cash, brokerage, and Roth. So one emergency won't create an even bigger tax problem. If this helped, you see your retirement accounts as one complete system, subscribe for more video like this, because the goal isn't to own every account. It's to build a system that gives you more choices when life changes. I'm Allison. I read the fine print, so you don't have to. I'll see you in the next video.